안녕하십니까. 오늘 이른 아침에 이렇게 많이 나와주셔서 대단히 감사합니다. Well, good morning, ladies and gentlemen. Before we begin today's lecture, a special lecture, I just want to say hello to everyone and extend my warm personal welcome to all of you joining us this morning at this very early hour. Of course, I want also thank Suyi Kim, making special effort to join us this morning out of her very busy and tight schedule to share her very, very successful experiences with the Canadian public pension system and pension fund management. I suppose your illuminating and the enlightening experiences will be highly valuable for Korea's policymakers in the related areas and also people involved in the Korea's public pension system and its fund management. In fact, you happen to be in town and we invited you and you accepted our invitation, so we appreciate very much. But it happened to be very, very timely. And many Koreans now very much interested in what should be the National Pension Fund's role and how it should be managed, what should be the impact and influence on our economy and our corporate system and governance system, and there's a lot of implications. So Canadian experiences will be very, very helpful. So in that regard, I thank you again for joining us, and I personally looking forward to listening to your presentation. Well, with this again, I would just say hello to everyone and thank you again for joining us. Thank you very much.
Is this working? Okay. Good morning, ladies and gentlemen. It's a great pleasure for me to introduce Suyi Kim to you this morning. I think this is a very special occasion for IGE as well, because as you know, we have more frequently covered issues on trade, growth, and many other macroeconomic issues. But we plan to move on to more diverse topics that are more closely linked to institutional management and policy implementation based on cross-country experience. In that respect, today's lecture is very special for us because, as Dr. Sagong has already mentioned, that there is an enormous interest in this subject, and CPPIB has demonstrated global leadership in this area. And personally, when I was with the NPS as chairman, we made a strategic partnership arrangement with CPPIB because I felt strongly that we could learn a lot from CPPIB. So it's a great opportunity for us to have Suyi Kim personally on this stage, who has distinguished career to date. She has 20 years of experience in investment industry, particularly in the area of private equity. Having studied at Seoul National University, which is not a bad school here in Korea, and Stanford MBA, she has carried out a very distinguished career, starting from McKinsey and Company, Price Waterhouse Coopers, and then moved on to the Carlyle Group and Ontario Public Pension Program, another important Canadian pension. So, most importantly, she has excellent track record in achieving exceptional rate of return over the last 10 years or so. Just to give you a sense, the average rate of return on CPPIB portfolio over the last 10 years is about 8%, if I remember correctly. And over the last 5 years, 12% rate of return. This is a very envious achievement in this industry. So with that, let's welcome Suyi Kim. Sorry, having too much introductory remarks.
Thank you so much, Dr. John, for your kind introduction. Yeah, and then thank you, Dr. Il, this morning for opening, and then thank you so much for having me speak this morning at IGE event. I feel very honored today. So today we'll talk about setting up Canada's national pension system for success. And I'll start off by talking about why this topic is an interesting topic and why this is an important topic for both Canada as well as South Korea. And then I'll discuss a little bit about how Canada has dealt with some of the challenges the country faced back in 1990s by talking about first how national pension system was reformed and how CPPIB was set up. And then I'll move on to talk about CPPIB's governance system and our investment strategy. And lastly, I'll talk about our current investment portfolio and then where we see ourselves going in the future. Okay. Simply speaking, I think national pension system reform is an interesting topic, given a common challenge that South Korea and Canada face today, which is the aging population. There are some similar aspects of fundamental demographics between South Korea and Canada. One of that being, as you can see on this chart, South Korea's life expectancy is about the same as Canada, now at about 82 years old. As shown in this graph, South Korea's life expectancy has gone up dramatically and passed the world average life expectancy at the end of 1970s, and then grew steadily. What does this mean? This means that at the individual level, there's a longevity, and then longevity poses risk that people will have a challenge to preserve their lifestyle of living multiple decades after their working lives. And what this also means collectively to the society is that it puts pressure on the sustainability of the retirement plan. Like many other countries, South Korea has the fact that they have fewer working population per retirees. And that that rate of growth in the retirees accelerate in the medium to long term. And this is also another common factor with Canada as well. But Canada not as fast as South Korea when you look at that. So South Korea goes down very dramatically. And Canada is slowly going down as well. And then it goes down to less than 4.5 workers 2 years ago. And then looking forward, that's going to also halve in the next 30 years as well. So what did Canada do in light of these challenges? That's going to be the topic for this morning. And I think that Canada is a step ahead of many other countries in terms of addressing this huge demographic challenges. So here I'll talk about how CPP reform took place and how CPPIB was set up. This summarizes the history of national pension in Canada. You may recall that in all the developed countries, back in 1950s and 1960s, there was this concept of the welfare state. Welfare state meaning that country needs to look after their citizens, and they need to look after when they retire. In light of that trend, in 1966, Canada also set up national pension, which is Canada Pension Plan, CPP. When it was set up as a pay-as-you-go system. For those of you who may not be familiar with the pay-as-you-go system, this means that current workers support the retirees. So you would work and then pay for your parents, and then your kids will work to pay for your pension, and so on and so forth. And then that system is pretty simple in the sense that if you know how much you need to, how many retirees you have, and how much you want to pay per retirees, you can calculate how much each worker needs to pay for. And when 1966, CPP was initially set up, in Canada, per retiree, we had 6.5 workers. So 6.5 workers could divide how much they can contribute to support one retiree. But soon after the national pension was set up in 1966, Canadian government realized that that is not sustainable, mainly because of dramatic decrease in birth rate. Why do you think that the birth rate fell off the cliff at the time? Does anybody have any ideas on what they may happen? What happened at the time? It was a birth control pill. In 1969, the Trudeau government, not the current Prime Minister Justin Trudeau, but Justin Trudeau's father, a Pierre Trudeau government, legalized the usage of birth control pill. And you can imagine, starting from the beginning of 1970s, that meant much smaller family. That meant more participation of women in the workforce. And that hugely changed the demographic picture. So there were a lot of papers and discussions that took place in Canada that, national pension is not sustainable, we need to do something about it. All of those in 1970s. And that there won't be enough people, the workers to support. So what did the government do in Canada? Actually, they didn't do anything. They didn't do anything in 1970s, and they didn't do anything in 1980s. But until 1997, and that what triggered in 1997 the act was because of the Canadian National Chief Actuary had a report in 1997 saying that if we do not make any changes to the national pension, there won't be any pension left by 2015. So about 17, 18 years down the road. With that sense of urgency. So you can imagine when people heard in the newspaper that you won't have any national pension left, there will be zero in national pension. There has been outrage of the public opinions, media was going after, and politicians had to do something. So in 1997, the federal and provincial government finance ministers got together. And at the time, we had a very strong leader in federal government, Paul Martin. He was the federal finance minister. Under his leadership, all the provincial government in Canada got together and they built the consensus of reforming the national pension. In fact, I mean, there is a book written about this that is called Fixing the Future and has details about how this negotiation and consensus building has took place. It took more than 3 years for each provinces and the federal government to go through the negotiation processes and build the consensus, how to reform it, and all of those. So after that painful process, in 1997, national pension reform was born. And I would say that that reform was very bold. It was bold in terms of the increase of the contributions. It was bold in a sense that the time frame, they compressed all the time frame in terms of how much they're going to increase the contributions. And it was bold because it also fixed the future. The way that they fixed the problem was that the chief actuary of Canada looks at the national pension sustainability every 3 years. And if and when there is a problem, instead of going through all the painful adjustment processes that they have gone through in 1997, there will be automatic formula kicking in to adjust the problems. So literally back in 1997, in Canada, they have fixed this problem forever going forward in the future. So in the future, if people realize that the sustainability is in the question, then discussion could happen between federal government and all the provincial governments. But after a short discussion process, if you don't build a consensus, if people don't agree to it, then there's an automatic formula. They can automatically adjust the contribution rate as well as the distribution rate. So I think that reform was really brilliant. I'll talk more about it later, but recently, Canadian finance ministers enhanced the national pension plan. I mean, this was in no way the reflection of the health or sustainability of the national pension. As Dr. John mentioned earlier, we have actually performed really well ever since we were set up. But this was in response to the concerns among the growing retirement insecurity, mainly coming from workplace pension plan and then voluntary savings, the lack of those contributions. So starting from actually this year, Canadian government implemented that there would be more contribution coming to the national pensions. So just 2 weeks ago, we have received additional pension contributions. This is the overview of the overall Canadian retirement social security system. Canadian social security system is a shared responsibility amongst the government, employers, and individuals. And I think this is similar to the South Korean retirement system as well. Canada has multi-source retirement income system with 4 main pillars. The first pillar is old age securities system and guaranteed income supplement. These are the programs that's funded by federal tax and then making sure to provide a basic level of retirement security to all Canadians. So there's an income test coming in for this one. And it's run by federal government. And second pillar is the one that in which our organization CPPIB plays an important role. It's a national pension, Canada pension plan. This is a mandatory contribution by employers and employees. And the source of income here comes from investment returns generated by CPPIB. The third pillar is a workplace pension, including pensions like defined contribution and defined benefits. Pensions like OMERS and Ontario Teachers' Pension Plans, and all of these fall under this third pillar. The fourth one is a tax-assisted individual savings vehicles. I think in Korea, this is similar to the personal pension insurance plans and personal pension trust plans. I'll now move on to talk about how CPPIB is structured and our investment strategy. As I mentioned earlier, in 1997 pension reform, we not only reformed the CPP, increasing the contributions and then fixing the future, we also set up CPPIB, Canada Pension Plan Investment Board, as a dedicated asset management firm to just manage national pension. And I think how it was set up, I mean, not only how the national pension was reformed was brilliant by fixing the future, how Canadian government set up to manage the assets for national plan, a pension plan was really brilliant. In a sense that how they structured the governance and they designed the CPP legislation, we call CPP Act, with just only one mandate, which is to generate the highest return without taking undue risk. CPPIB is a private company operating a public trust, and that we're governed by, as I mentioned earlier, CPPIB Act. We operate at an arm's length from the government, and our board members are highly qualified. And then when CPPIB Act was set up, it was ensured that when we bring on the board members, their qualification is vetted, and that they can contribute for our investment strategy setup. So ultimate responsibility for CPPIB lies with our board members. And our board members delegate the day-to-day operations and execution of the strategy to the management team. More precisely to the CEO, and the CEO has all the right to hire all the investment professionals and everybody else within the organization. Currently, we have 11 board of director members. And when we look at the composition of the members, they come from generally all commercial background. There were CEOs of leading Canadian banks, RBC, Royal Bank of Canada, or they used to run the company like Four Seasons. We have board member who represents actually Asia Pacific region. He used to be the CEO of DBS, and he was running JP Morgan's Asia business. And he's also on the board of HSBC globally. So you can imagine when we go to the board meetings, the kind of directions and advice that we get from the board members are at a very high quality. And our board members always encourage us to think outside the box. They always encourage us to do better. And they always give us good guidance on where to look at things. So I think having that governance structure to manage CPPIB really has been able to make us our track record that Dr. Jun mentioned earlier kindly. In addition to that, why we're not a publicly listed companies, we adapted the transparency to follow similar to the publicly listed company standard, in a sense that we report quarterly earnings. We also publish the annual report. And all of our investment holdings are on our website. So you can find a lot of information from our website and our annual report. Just quickly going back to also CPPIB's investment strategy and how we have decided to do what we do today. When CPPIB was initially set up back in 1998, we actually did not have that much money. As you may be able to guess from what Chief Actuary said in 1993, pension fund was dwindling, and a lot of those capital was actually used by provincial government who needed to use those capital to build bridges, highways. There were a lot of infrastructure boom at the time, and then they needed capital to be able to do that. So when we were initially set up, what we had was a lot of non-marketable government bond, provincial bond, mainly the provincial government bond. And then we had to wait for that security to come due to be able to have the cash, plus the additional contribution coming from the workers. So initially, our investment strategy was similar to many other pension plans, was a passive strategy. Go low cost, low complexity. We only had a handful of people, including our board members. And as we built more cash base and capital base, we started thinking from our board, should we continue to do this passive investment strategy, or should we do active investment strategy? You already know the answer, that we have decided to go for the active investment strategy, which means that we believe that we can beat the market passive investment strategy, which means that we can beat the market returns. And then why did we think that we can do that? It mainly came from some of the advantages that we believe that we have. I would say that there are two separate parts of the advantages that we believe we have. One is a structural one, and the other one is developed advantages. In terms of the structural advantage, we have the large size and scale. This is very helpful in a sense that when you look at the larger deals, there are only few players in the world, although it's a growing pool of players who can address that. So having the size and scale helps. Second structural advantage is having the certainty of cash flow. I know that some of you manage assets, and you probably understand how important this is, that your money is there, and that your money is there for long term. And that you know that when cash is coming in, and then you know that when cash may need to go out. So what does this mean for the investment? For example, over the global financial crisis in 2008 and 2009, a lot of asset managers had to deal with the redemption of their capital. We didn't have to worry about that. A lot of sovereign wealth funds, which is also very large, they didn't know whether they're going to get any additional funding. I mean, their cash flow is not predictable. And some of them had to return the money to the Ministry of Finance or central banks at the time. Right? When a lot of these other players couldn't invest, we had cash flow that continued to come in, and that we were able to look at larger transactions at that time at a very attractive valuation. So one of the best investments that we have done were the investments that we made back in 2008 and 2009. Another thing is that flexibility also leads us to continue to deploy capitals every year, which a lot of you probably also know as well, that it's very important in long-term return generation. Third structural advantage is a long-term investment horizon. We are a pension asset manager, so we need to be around for generations after generations. Our chief actuary assess our performance on 75 years horizon. So our chief actuary comes every 3 years and look at whether national pension is managed well on a 75 years sustainability basis. And actually that gives different, because the evaluation, when the evaluation happens, I think a lot of other sovereign wealth funds and pensions and other asset management firms, they need to worry about annual performance, quarterly performance. But when the evaluation happens for 75 years, your mindset could be very different. And then all our investment strategy could also align with that. And then being a long-term investor is something that we really focus on in our investment strategy. The other part of this advantage that we have is a consciously developed advantages. First one is a talent and high performance culture. As you all know, as an investment organization, talent is the most important. So when we decided to go active, we said that, okay, we're going to go build an organization which focuses on talent. And then we're going to attract expertise. We're going to attract high-performing talent. To be able to do that, as you can imagine, we pay market compensation. And that I think is one of the key differentiating factor versus a lot of large pool of capital that we see in the market. Second thing is smart partnering. We take partnership really seriously. Globally, we now have close to 200 investment partners. That's our external partners. And then we aspire to partner with the best local and global players. And our deep involvement in investment and our active investment also allows us to work with our partners very closely. Being able to look at the investments together, being able to manage the investments together and portfolio companies together. And then you get to know them very well because you'll have to stay within the companies and portfolio companies when the market is up and down. You get to build the trust with those partners. And if you ask me what I'm most proud of in Asia for the last 10 years, I would say building the partnership in the market is one of the most proud achievement that we have in Asia. And we have that globally. Third advantage that we developed is a total portfolio approach. I won't go into details about the techniques of what total portfolio approach works and things. But what's the most important part for that is this is a flexible investment approach. You probably have seen in a lot of asset management firms and pension plans, they have this allocation, geographic allocations and asset class allocations, and that you have that allocation annually. So at the end of the year, if you don't meet the allocation, you push the capital out into certain sectors or certain areas. Or beginning of the year, you open up the allocation, so you start going investing. We don't have those artificial allocations. So this gives us a lot more flexibility. Another example is going back to also global financial crisis. When a lot of other pensions had a problem of denominator problem. I don't know whether you heard about this denominator problem, which means that because the public market valuation went down dramatically, your public to private proportion went out of the whack. So your private portfolio proportion has gotten too big versus the public portfolio. But a lot of that is actually time lag as well, because again, public market valuation fixes first. We didn't have the strict allocation and then numbers that you need to adhere to in the short term. So when other pensions had to rebalance their portfolio and had to sell, for example, private equity portfolio, we were a big buyer. In fact, we have expanded our private equity secondary portfolios at that time dramatically. And then we came up with a new strategy of also supporting and buying the entire portfolio of general partners. So you would buy the entire private equity firm, which was struggling to fundraise. Our total portfolio approach allows us to take those flexible approaches depending on the market situation. So these are the advantages that we believe that we have. And then these are the advantages that allowed us to choose more active investment strategy. So where do we stand now? We currently manage about 370 billion Canadian dollars of assets. Over the last 10 years, we generated a little bit more than 9% annual return, which is way above what is required to sustain the national pension, which is a little below 6%. So it's about 4% real plus inflation. Inflation is a little less than 2% in Canada. And thanks to the pension reform in 1997, as well as the additional national pension contribution starting to coming in this year, our asset size is expected to grow rapidly. And by 2035, we're forecasted to reach about 1 trillion Canadian dollars of assets under management. One other thing is that when I look at our current asset of about 70 billion Canadian dollars, almost 60% of that comes from return investment income that's generated, that largely coming from the compounded returns over the last 10 years. I just want to talk about one more point about how we're managing this public trust and national pension. We believe that it is very important, again, as I mentioned earlier, that we have the transparent management of the national pension. And that is to really preserve the public trust for CPPIB. Not only being transparent and having these reports published on our website, we also proactively communicate our strategy to the general public and government, legislators, and industry associations. We recently came up with a campaign called Speaking to Canadians. That is a very brief and short video clip that we play on our website as well as some of the TV stations to bring up the awareness of what national pension is doing in Canada. Believe it or not, the national pension crisis was back in 1993 and 94. But when you took the public opinion, public poll, people still remember that. And people still think that national pension won't be around. So we found that having that campaign and then bringing up the awareness of what national pension has been doing and then giving people more security, well-deserved security for the national pension is important. So that is what we are also doing as well. And I'll talk a little bit about how our current portfolio looks like. So this is how our current portfolio looks like by geographic split. As you can see from here, we're very well diversified. And diversification is one of our key investment strategies. Our chief strategy tells me that there's no free lunch in the investment world. Only one free lunch that you can get is a diversification. So we're going for that. As you can see here, US is the largest market for us, more than 35% of our assets invested here. Canada, which is now below 15% of our assets. When I first joined CPPIB, this was the other way around. Canada was more than 85% of the total fund. So over the last 10 years, we have gone through dramatic transformation, globalizing our investment portfolio, globalizing our institution. And also when you look at the portfolio, if you add the Australia, which is under Asia Pacific, and Asia, Asia represents about 25% of our total portfolio. I think that's one of the highest proportions amongst any global institutional investors. And this is how it looks like based on asset class. Again, it is very well diversified. We invest in public equities, private equities, infrastructure, fixed income, and many different kinds of credit investments. As I mentioned earlier, long-term strategy is very important. So what we do at CPPIB is that we not only do annual business plans and annual plans, we try to look longer term, and we set up 7 to 8 years down the road what our long-term plan is. So back in 2013, we did a strategy for CPPIB 2020. And just last year, we had done a lot of work and then set our strategy looking at CPPIB 2025. Within CPPIB 2025, there are about 4 key pillars that we have said that we're going to achieve. On the investment side, we said that we're going to invest 1/3 of our assets, our total assets, in emerging markets. We continue to believe that emerging markets will outperform in terms of the growth. Emerging markets is actually about more than half of the global GDP, particularly out in 2025. And the emerging markets constitute about 2/3 of global growth. So we made that big statement that we're going to be 1/3 in emerging markets. Secondly, we said that we're going to go everything with the technology and data, putting technology and data in the middle and center of our operations and our investment strategy. And third thing, as you can imagine, particularly both first and second point that I mentioned on the investment strategy, for a lot of people, that's a change of the mindset and how you need to work. Right? So third pillar that we have said is really building the culture, adaptive culture, in addition to very much mission-driven culture that we have internally, to be able to achieve first and second goals that I mentioned. And in Asia Pacific, when I look at what that means for actually my responsibility and the market that I'm focused on in Asia Pacific, we have now about more than 90 billion Canadian dollars invested in Asia Pacific. And Asia Pacific investment performance has been better than the overall firm's returns. I wouldn't say that it's all because of the people on the ground, or let alone myself, but the market has been very great as well, and we have performed very well. So when we set up the long-term strategy, our board has said we want to invest more in Asia. So by 2025, we're expected to have about 35 to 40% of our total assets invested in Asia Pacific. Because the biggest emerging markets in the world are in Asia, so China and India. And then we also have large developed markets like South Korea, Japan, and Australia in Asia portfolio. So that was a big vote of confidence, and that we have a lot of work ahead of us to fulfill our objective. That's what I have prepared for this morning's remark, and happy to take questions.
Thank you very much, Suyi, for your very illuminating speech this morning. I'm sure there are a lot of questions from the floor, especially from the press who are present over here. So for next 20 minutes, is it okay? 15, 20 minutes. Yeah, okay. Yes. Yes, please, Mr. Kim. Yeah. Oh, Mr. Tan? Oh, okay, please.
Thank you very much for your very comprehensive presentation. I'm interested in to know how Canadian, PPP exercise the stewardship to those companies, you invested. The stewardship in Korea is one of the hottest issue, and the Korean, the national pension is almost ready to influence on the managerial ownership of the major conglomerate in Korea. At the moment, the Korea's national pension owns about 5% shares across almost 300 companies. If Korea's national pension start to exercise this stewardship, it has enormous implications for Korea's governance system of the corporate, and we are not sure whether this will guarantee the objective and the profitable operation of the national pension. So I would like to hear your comment on this Korea's development and how the Canadian, the PP, the exercise here stewardship. Thank you.
Thank you. I understand that it is a very hot topic in South Korea these days. We are a big believer of active ownership. I don't think we need to have 1,600 professionals unless we're going to be an active owner. And that we believe active and value-adding ownership gives us extra additional returns that we are designed to achieve. So more specifically on the stewardship and the responsible investing, back in 2013, we have set up our internal team to look at how we can be a more responsible investor. And that we have a team dedicated with the expertise to guide our overall investment department whenever, not only when we look at investments, but also after making investments. And we believe that this is a partnership, not only the active owner or shareholder like us, but also the board of directors and then the management team. As you can imagine, depending on how much stake that we own and the companies, whether the company is a listed company or non-listed company, the degree of influence is quite different. Generally, for the unlisted company that we own meaningful stake, we very actively get engaged on the board, as well as appointing the management teams and working with them and guiding the company's strategies. For the listed companies where we own minority stake, that is a bit challenging. It's not so easy to see the details of how the board of directors are operating, and then how the process is set up, and et cetera, and et cetera. So we have to rely on the disclosure of the companies. But we don't think the disclosure is enough. Oftentimes, what we try to do is by engaging with the companies, we fill the gap of that communication. I don't think we're the only party. I think a lot of large global asset management firms have adopted this active ownership and increase, the group of teams and an expertise within their organization, whether it's BlackRock, Vanguard, Aberdeen, CalPERS, and CalSTRS, and all these large organizations. And there are a lot of research done about the active ownership bringing additional returns or avoiding, more importantly, the mistakes. I can go on and on about what are the examples of the active ownerships and benefits and things like that, but you can see that we're a big proponent of that. And we're glad to see that is spreading out to Asian countries as well, that shareholders are actively participating, value adding to their portfolios.
Suyi, just to interrupt, because Professor Ahn raised such an important question that draws a lot of attention these days in Korea. The really sensitive part of this question has to do with whether or not the governance of executing body in Korea, NPS, is independent enough to exercise shareholder rights in a most productive and professional way. Or if it's not, the governance structure is not really fully independent of or political influence, then NPS involvement may distort the true intent of stewardship code or whatever the guidelines we have, like ESG factors or others. So that's the thing. CPPIB's big merit you mentioned is the truly independent professional body, right? That contributed to the exceptional performance over the years. But here the question is, this NPS governance is not quite there yet. So that's the debating point. Just to interrupt. Any comment on that one?
I'm not familiar with the NPS's governance model, so I won't comment on that specifically. But what I can tell you is that we aspire to set a good example within our organization, how our organization is managed. And then through that, I think we can show a lot of our portfolio companies. We would like you to also follow how we do it. I mean, one of the good examples is that the composition of our board. I mentioned earlier the strong expertise and diversified skill sets our board members bring. And that was based on the conscious mapping of what are the skills that we need for our investment organization to go to the next level. And we also have a great diversity in, for example, gender diversity. Our chair, board chair is a woman, and then we have about 60% of our board members represented by female as well. So we take the diversity very seriously, particularly as an investment organization. Bringing the diverse perspective really matters in making the best investment decisions.
I think we are not getting to the point. I try to to put this question more bluntly. That is, right now our national pension service is under the thumb of the government, and stewardship code is kind of being used as a the government tool to put the the pressure or take the control of how the national pension service operates. So, in other words, for example, right now the under the pretext of the stewardship code, the National Pension Service has recently talked about the changing the ownership or management control of the Korean Air. So that's the question is it proper or is it beneficial or is it detrimental to the operation of National Pension Service when the government exercises excessive control over how it is operated?
Again, as I said, I cannot comment on the specific cases that I'm not so familiar with. Again, but I think the active shareholder ownership and fulfilling the fiduciary duty as an asset manager, it's something that we strongly advocate. And as you can see that how we actually go by and look at those, what are the standards and then guidelines that we have on how we encourage our portfolio companies and what we like to see in the governance. We have this proxy voting guidelines on our website. We disclose all the votings that we have done for publicly listed companies. So we have this transparent and then standard that we put in place and principles that we continue to update. And I think that is important that we encourage our portfolio companies to follow those standards that we believe is going to help in generating value longer term.
I tried once again. I tried to make it even more bluntly. Our president, the Moon Jae-in, and encouraged National Pension Service to exercise or put the pressure on the particular company to behave better, because, for instance, the Korean Air has a lot of problems. As you remember, it's the not rage. I don't know whether you remember that or not. It's management. The ownership family, owner family has a lot of problems. So I think in a way, our president encouraged the National Pension Service to exercise, the use its the stake in that company in Korean Air, and help remove the management control of the current owner family. What do you think? You're still not familiar with the decision.
So what I can tell you, again, is that we believe that it's important to set those guidelines and principles, not because of the certain cases that is coming up, but because based on a lot of research and work, what you like to see from your portfolio companies. And then looking at every single situation is based on those principles. Right.
Okay, I think we should protect Suyi from any awkward position that she may be in. Okay, moving on to the next question, Mr. Kim. Okay, all right. Okay.
I'd like to ask you a question about the CPPIB, the compulsory system.
Yeah.
First of all, is this system-wise very comparable to the U.S. Social Security? Number two, is the magnitude of withholding about comparable, or is it changing constantly, raising up? In the U.S., as they need money, the Social Security rate has been going up. How does the Canadian system been going up? That's one question. And another one I like to ask is your total asset management approach that is without constraints by the category. It gives you a lot of flexibility, and I'm sure it contributed in your performance as well. But all these things, system is very good when it works well. But people have constraints also for reasons of protecting against the risks. Now, we talked about this national pension system interfering with management of the companies. When the government is very sophisticated and well democratized, we have less concern about this. But the country like Korea, we have less than satisfactory institutional system. Therefore, how do you see that giving the total flexibility, protecting against the risk that you may worry about? Thank you.
Yeah. On your first question about the U.S. Social Security system, I'm not so familiar with the U.S. Social Security system, but on the contribution rate, after we reset in 1997, almost doubling the contribution rate from less than 5% to almost 10%, we didn't have to adjust it. In fact, based on those automatic formula, given our our historical performance of 10 years, we could have probably adjusted down. But we didn't have to increase for sure so far. It's 9.9%. That's split half and half between employer and an employee contribution. But as I mentioned also, Canadian government realized, and also general public as well, although the second pillar out of those four pillars, the national pension system, has been working really well, the third and fourth, which is workplace pensions and individual savings, have been lacking. So recently, government has said, okay, why don't we give more to the national pension? I think, again, that was a bigger responsibility for us and strong vote of confidence. So as a result of that, starting from this year, the contribution rate goes up. It's not because, again, national pension won't be there or it's at risk. it's because national pension has been doing well. We want to shift more of the other retirement savings to the national pension. So the rate is going to go up to close to 12% by 2023, up to an income level of about 70,000. And then above 70,000 to 80,000, there's also additional contribution that could come in for the income level higher. Yes.
Okay, perhaps one last question.
And then
okay,
also,
sorry.
you mentioned about the TPM and the risk management. Risk management is a key part of our investment strategy. As I mentioned, we only have in Canadian CPPIB legislation one mandate, one line, actually one sentence, maximize returns without taking undue risk. So risk is a key part of our everyday management of the portfolio, key part of the total portfolio management approach is architect, and then we monitor very closely. And then I would say that legislation was well tested over the global financial crisis. You may recall that at the time the market went down 25 to 30%. Our portfolio return was about a little less than negative 18%, so we did much better than the market. But you can imagine, no citizens like their money being lost, and then when you put it into the dollar amount, it was $15 billion that we have lost. But even over that period, our board has been very supportive. We didn't get any call from Ottawa, which is our federal government. So they had a strong belief on how they set up the national pension as a system. Even with that, coming out of that, as Dr. Jun mentioned, we generate more than 12% of annual return. We have shown very strong investment returns. That also showed the framework that we set up has worked. Doesn't mean that it's going to work forever, but our management team and the board are very much aware of the risk management and how we should do the diversification. So that's one of the reasons why we have been going really strong on the diversification globally.
Okay, I recognize the gentleman.
예, 설명 잘 들었습니다. 저는 이제 수익률 관점에서 한번 여쭤보고 싶은데요. 금융시장 전망에 대해서 지금 보면 이제 미국 기준 금리 기준으로 2.5% 낮지 않은 금리 수준인데 미국의 뭐 예를 들면 향후 S&P 주가의 흐름이라든지 뭐 중국이라든지 한국이라든지 이런 전체적인 금융시장의 흐름에 대해서는 어떻게 생각하시는지요?
I think we have our strong returns for the last 10 years, particularly 5 years. As I mentioned briefly, it's not only because we have done well and a great framework and strategy, but also the market has been very strong. So looking forward, it's more likely that we will not repeat what we had in the past. It's more likely that we'll see the market adjustment. And we're trying to get ready for that. We have seen the strong adjustment and some market corrections in the US, as well as I think China market corrected the most last year, which is within our portfolio. But I'm happy to say that our active public market, our all active programs, including the public market investing program, has outperformed and had a positive returns in Asia.
It's time to close. Ladies and gentlemen, could you please join me in thanking Suyi Kim for her excellent speech and follow-up this morning. Thank you.
감사합니다. Thank you.